Welcome. It's great to have you with us. My name is RJ Kelly. I'm founder and chief visionary officer of Wealth Legacy Group here in lovely San Diego, California, but we've got clients in 21 states and growing. And our practice is a multidisciplinary and holistic. Although assets under management do represent a significant part of our practice, as well as our tax mitigation group. But we also do a substantial amount of specialized type of life insurance, disability insurance, long-term care insurance. And in the course of that, I joined a group several years ago called Elite Producer Group, headed up by Tom Toos. Tom said, "You've got to meet Bryan Setzler." And I'm so glad that I did. Bryan is truly in pretty much any room that he's in. Bryan Setzler is going to be one of the smartest guys there in the room, but also truly one of the nicest people I've had the pleasure of getting to meet. So we were having fun on a call a couple of weeks ago on another case for a wonderful client of mine. And I was asking his opinion on some things and how could we design it in a certain way. And it was just, we're doing so well. I said, Bryan, this is such great stuff. And particularly if we're talking about business succession, which is where I get brought in a lot. How do we sell a business and either reduce, defer, or even eliminate the taxes on the sale of that business? Or if we want to sell real estate, but not do a 1031 exchange, how can we again reduce, defer, or even eliminate the taxes on that real estate? Particularly if you're in a high tax state like California at 37.1 or New Jersey, which is even worse than California. I didn't think that was possible, but yes, it is at roughly 40%. But New York's also horrible. Illinois, great people, but just horrible tax rates. So if you happen to be unfortunately in any of the states, you definitely want to pay attention. If you have a business and you're planning on selling it, how are you going to pay the taxes on that sale? Because in many cases, business owners will give a number to the business broker or the investment banker. Say, this is how much I want to sell the business for, 10 million. But the business valuation is done, it comes in at 7 million. You say, well, no, but you have to sell it at 10 million because after I pay my taxes, that's what I need to live on. Well, it doesn't work that way. You have to sell it for whatever the fair market value of the property is. But if we can sell it and either reduce, defer, or even eliminate the tax on the sale, now we're talking. Now you've got more room for negotiation. So Bryan, you were sharing some ideas, great ideas with me the other day that I had absolutely never heard of before. In fact, I've never heard of anybody even talking about this idea before. So with that, my friend, you're on. Take it away.
Well, thank you, RJ. Over the last 3 or 4 years, we've worked with advisors who bring us clients that might be in the middle of a business sale. They're in the process of selling a business, or maybe they just recently sold a business. And so, of course, they have money left over and they would like to make a smart decision as to where to deploy that capital into something new. But there are far more businesses that are many years out from selling. And so what we thought we should do is not only come up with solutions for the person that's selling the business today, but it got us thinking about, well, what could we do for someone that has 4 years to go, 7 years to go, 10 years to go before maybe they'll sell their business, to get them better prepared for that transaction. This case, ironically, is in New Jersey. It's funny that you brought New Jersey up. And so there are 3 brothers, and we showed them this slide, and these slides really resonated because it was these concerns. What if I die before I sell my business? The selling price concern. What if I'm unable to get what I think my business is worth, to your point? What about the income tax I have to pay on the sale of my business that's assessed to me? Where do I invest the proceeds? Meaning, what if I make a bad decision or I invest the money and then I get a poor sequence of returns? What if it's 2008, just subsequent to the sale, and I feel foolish that maybe I made a foolish investment decision? Will any of that cause me to feel less wealthy because I paid income taxes and maybe I made a bad investment decision? What's the impact to my estate? And what am I going to do with all my free time? These are the kind of concerns that these guys worry about all the time. So knowing that, what we thought we would do is see what we could do to build out a planning process to address all of these concerns, except for the how I will spend my time. I joke and say that's a high-class problem. I can't help them with how they spend their time, but I can help them with the rest of it. And so the idea here is, what if they were to pre-fund an account way ahead of time? And if they do, that enables them to have a product they're already familiar with, that has certain unique tax advantages to enable them to actually deposit either all or most of the future proceeds into a special account. And if they do, there's certain benefits that address all these concerns. It has life insurance in the plan so that if someone were to die too soon, that life insurance will provide the future value of the sale of that business to the family of the decedent. So that is really beneficial. Selling price. What if it's a bad time? What if the business had been worth $10 million, but maybe because of circumstances, interest rates, cap rates, economy, competition, consolidation in the industry, whatever it may be, what if they're only able to sell that business at 70 cents on the dollar in your example, 7 million instead of 10 million? What is the impact to their post-retirement cash flow? Income tax, we talked about. This product is unique because it enables us to finance the income tax burden associated with the sale from the exact same product, enabling the business owner to have complete control of the gross proceeds of the sale, not the net. So when you think about all that, it's really pretty powerful. It is also a tax-free account. You have a place that there is no taxes on the growth of the money, and also it's protected from loss. And what's powerful about that is if in the future you're allowed to put a large lump sum into the product that's completely accessible and completely liquid, it's not a scary place for the business owner to entertain the idea of putting the money somewhere because they're not locking the money up beyond their reach. Mm-hmm. That's the whole trick.
And some states as well will also treat cash values of life insurance contracts as creditor proof. Now, in California, that's not the case. We do have limits on how much can be placed into insurance contracts, but you can have in many states 100% of those cash surrender values, even if it's 10, 20, $30 million, and it's not accessible to creditors. And on top of that, for those that are trying to help their kids go to school past high school, whether it's college or maybe they're wanting for a master's or a doctorate, it gets very much shall we say, you have to almost strip down because you've got to put all your financial information in front of both the government as well as the university. And so there's something called a FAFSA, FAFSA, free application for student aid, that you have to disclose virtually all of your assets, but on life insurance cash values, those are not disclosable on that FAFSA form. So again, you might have several $1 million accumulated in your insurance contract, but it does not have to be disclosed to FAFSA. And I have not yet seen any individual universities or colleges require that to be shown either. Doesn't mean they won't ever, but thus far, I have not seen a single one that's ever asked for that. Certainly, again, not on the FAFSA.
Excellent points. I hadn't thought about putting those benefits on this list of benefits. What we discovered is that many times we're able to triple or quadruple the post-sale benefit, the lifetime income stream, the lifetime get to spend, and overall wealth transfer to the family if they just plan ahead. So this individual is projecting his share to be $2.4 million. What he wants to do is take the other $1.2 million and buy a home with it or some other larger purchase. So his idea is to take the other half, $1.2 million, borrow the tax, or ordinarily he's faced with a $600,000 tax burden because that 600 is not based on the 1.2, it's actually based on 2.4. That's the reason it looks so high. What we're trying to do here is force the business owner ahead of time to go ahead and calculate their projected income stream coming from the remainder of proceeds left over from the sale, so it sets a realistic expectation. In this case, if you have $600,000 left, 1.2, open the account, but you have to take away the tax, and you invest it at 6%, that's only $36,000 a year, and then you have tax to come off that. So that means it's only generating a very modest $26,000 a year get to spend number from what started off as a $1.2 million transaction. So what you were talking about earlier about the disappointment in the business owner in comparing the income that he's expected to benefit from after you deduct the capital gains tax, after you deduct the income tax on any sort of fixed income investment, invariably they're going to be disappointed. So what we're trying to do is do a much better job for that business owner by asking them to plan ahead of time so we can make a big increase in their spendable result. So the idea here is that we're asking them to establish an account early, deposit the future proceeds into that account, allow us to design it in such a manner that we can control the tax financing so they get the benefit of the gross value, the pre-tax value, not the post-tax value. Use a policy loan to handle that and have that loan repaid upon their death from the policy death benefit. And if we do that just right, this is an example of the client paying $100,000 a year in years 1 through 10 pre-sale. And then once they put the 1.2 in and borrow the money out, they're at 165, then 210, and then $300,000 a year to spend, which is an $11.5 million post-sale projected retirement result. And at any point, there's between $2 and $4 million of life insurance for their family. So it's a dramatic difference. So the comparison would be if you plan ahead, you're at $11.5 million of post-retirement cash flow against 2.7, and $11.9 million of age 100 money left in the account versus 0. So we're at $23 million against 2.7 from the exact same money. Now this guy's 47. 53 years to age 100 is a long time, RJ. But I hope you agree with me that 23 million is more than 2.7 million.
I think so. Let me get my calculator. I'll be right back. No, that's dramatic. And again, because many have not been told that their life insurance, that the values that you can bring out of life insurance contracts, even if that value greatly exceeds your premiums paid, as long as it's properly designed. And again, that's why you would want to work with people like myself and Bryan, is to make sure it is in fact correctly designed so that when that money comes out, even though it exceeds the value of what you put in, it won't be taxable.
Yeah, so he was very thrilled with this result. There are 3 brothers. They each own 1/3 interest in this particular company, and we feel like they're all going to do something. Now, this example at $100,000 a year, certainly it could be less. Part of the reason the numbers in this case are so fantastic is he's willing to set aside $100,000 a year for 10 years ahead of the sales, 10 whole years for that money to grow on itself. Many cases, the client wants to put the minimum amount early, which is fine. So in each case, we will design it custom, specific to the needs of that particular client. So I don't want the $100,000 a year price tag to be something that's prohibitive to exploring whether or not something like this could benefit you. But in every case, whether a person is selling a $30 million company, or in this case, a $1.2 million asset, the magnitude of the improvement in most cases is 3 to 5 times where they would have found themselves if they were just willing to do a little bit of pre-planning ahead of time. And in talking to some of the very large CPA firms, they agreed with me that even the big firms do not do anything in the way of forecasting a future sale. They answer the telephone if a business owner calls them and says, "Hey, I'm thinking of selling my business this year. I have some buyers. Will you please meet with me so we can calculate the capital gains tax associated?" So then they engage right at the end when there's something to be done. What we're suggesting is there's tremendous value in spending a moment, an hour, what have you, forecasting a realistic future value and a realistic income tax burden over a realistic period of time, given the fact that this asset is the most important asset in the life of that business owner. You spend his entire life building it, only spends 6 months probably getting ready to sell something like that, only gets to sell it once. It seems to me like it would make all the sense in the world to just do a little pre-planning years in advance.
You think. I'm a CEPA. I'm a certified exit planning advisor. And in fact, while I'm thinking about it, we do have a book that I had the privilege of being included in with 12 other wonderful CEPAs from across the country. And so if anybody's watching this video and they'd like a free copy of that book, just write us at info@wealthlegacygroup.com, info@wealthlegacygroup.com. Be sure and get that to you. But the research shows that over 75% of businesses don't sell. They just simply don't sell for a variety of reasons. But part of it is the late Stephen Covey wrote in The 7 Habits of Highly Effective Leaders, is that we're to begin with the end in mind. And so, Bryan, what I like about what you're saying here is you're really challenging business owners to think ahead. There's some wonderful groups. Vistage is one, and there are several other groups that are focused on working with executives and business owners. But that's one of the major challenges that a Vistage chair will make to any new member. And that is, what is your exit strategy? And some people go, well, that's unfair. I just started my business a couple of years ago. Well, no. As Stephen Covey says, begin with the end in mind. That the best exits are going to be found for those that have already been thinking about it, planning on it for the 10, 20, even 30 years in advance. So, Bryan, that's what I really like about what you're saying here. This gives a terrific bucket in which deposits can be made. Again, the same thing. This is not a cost or an expense because that money is building up value inside the bucket. So if there was money that was needed for an emergency or opportunity in the meantime, that money could be used, although, again, remember what it's there for, is there to pay that future tax on a very expedited way. So what else do we need to talk about, Bryan, that would be helpful for us to consider in this case? I mean, increasing the net spendable and takeaway by 3, 4, 5 times as much. If that's not compelling, we better check for a pulse. But what else?
Yeah, I just encourage any business owner that's listening to this to circle back with RJ to be willing to spend just a reasonable amount of time getting to know each other to explore this idea. I don't see how in the world anyone would regard it as wasted time. I don't think for a second any business owner is getting a phone call from anybody who's a financial advisor and saying, hey, I would like to talk to you about making sure that the proceeds from the sale of your business, even if it's 10 years into the future, can end up being 3 to 5 times greater than if you only spend an hour talking about it with me. It seems like a very reasonable thing for them to do.
Makes good sense to me, Bryan. So that we're talking with Bryan Setzler of Optimus Life Designs, a wonderful practice. Again, another national practice. So we really team up, and it's there's some things. I've got a client of mine that is in a situation where he wants to continue life insurance because unfortunately, there's been a change in health for him, but as well, there's also been a change in health on his balance sheet. And so particularly the spouse is concerned about how will we be able to continue this life insurance after it's no longer just temporary insurance. And so Bryan has shown me some very clever structures that we could use to do some internal financing where the contract, actually we can borrow from some of the values inside the life insurance contract and dramatically reduce the cost of acquisition and the ongoing premium to keep this coverage in force. And please God, for a long time for my friend. But again, there's some things that might make that a shorter life expectancy than we would hope. But nonetheless, Bryan, thanks so much. Just a continuation of the great talk we had a couple of weeks ago. You truly are one of the brightest guys in any room. So thanks for being with us. Again, I'm RJ Kelly, Wealth Legacy Group. You can reach us at 858-569-0633. That's 858-569-0633. Our website, wealthlegacygroup.com. Wealthlegacygroup.com. We got tons of videos and articles and things that you might find helpful. Sure hope. And then also send us an email if you've got a question or you want to see a different video. Let us know. We'll put it in the oven for you. Send it to info@wealthlegacygroup.com, info@wealthlegacygroup.com, or maybe you'd like to talk and have Bryan and I put together some numbers for you on if you're a business owner and want to look at pre-funding your eventual sale. So with that, take good care, and we'll look forward to seeing you on the next video. Bye for now.